What if you could go back in time and trade any moment in history just like it was happening live? Imagine being able to pause or fast forward price action to test your trading strategy or replay trade setups in an instant without having to wait days or even weeks for them to form. Well, that's exactly what the Soft4FX Forex Simulator lets you do. It's hands down one of the best tools for testing, practicing, and improving your trading skills, especially if you're serious about becoming a consistently profitable Forex trader. And that's why in this video, I'm going to show you exactly how to test your trading edge like a pro trader using the Soft4FX Forex Simulator. We'll cover everything, from downloading the MetaTrader trading platform and installing it, to setting up the simulator and even taking a couple of trades with it using my advanced trend trading strategy. We'll even explore and compare the features of the simulator's demo and full versions. By the end of the video, you'll know exactly how to test any trading strategy to see for yourself if it works, long before risking a single penny of your hard-earned money to trade with it. If you're serious about becoming a consistently profitable Forex trader, this might just be one of the most valuable videos you'll ever watch. So let's get started. Alright, first things first, we will need to get the MetaTrader trading platform installed on your computer. Don't worry, the software is completely free. If you already have MetaTrader installed on your computer, feel free to skip ahead to the next section of the video. But if you're starting from scratch, stay with me because I'm going to show you exactly how to do that. We're actually going to be downloading the MetaTrader trading platform from Exness, which is one of the Forex brokers which I highly recommend. As of the time of making this video, they've got excellent spreads, low commissions, and lightning fast execution speeds. Plus, you could even get zero spreads on almost all pairs through their zero spread accounts. So open up your browser and head on over to exness.com or just click the link below. After logging into their client area, you'll first need to create an account and then click on the button which says trade. Once you've done that, just click on the MetaTrader version corresponding to the account type you created to download it. The download should start automatically, and since the software is a relatively small file, it should only take a few seconds to complete. Once it's done, go to your computer's downloads folder and double-click on the setup file to run the installer. You might get a security warning asking if you would like to allow the app to make changes to your computer. Just click yes. The MetaTrader installation wizard will then open up. The installation is a pretty straightforward process. Just click next after agreeing to the software's terms and conditions. You'll see a progress bar filling up as the software is being installed on your computer. That should take maybe 30 seconds to a minute to complete. Just click the finish button to complete the installation. The MT5 application you just installed will now open up for the very first time on your computer. You should see the main MT5 interface with price charts, the Market Watch and Navigator windows on the left-hand side, and the Toolbox window at the bottom. Now that MT5 is installed and running smoothly on your computer, let's move on to the next step of the process, which is setting up the Soft4FX Forex Simulator. This is the tool we will use to test and validate our trading edge in a realistic, risk-free environment. So let's get it set up and ready to go. To get the Soft4FX Forex Simulator, just head on over to their official website by clicking the link below. On their downloads page, you'll see that they've got both MT4 and MT5 versions of the software. Now, since we just installed MT5, we're just going to download the MT5 version of the simulator. To do that, just click on the Download Installer button. The download should be quick since the simulator is a pretty small file. Once it's done downloading, go to your downloads folder and find the Soft4FX installer file. Double-click it to run the installer. The installer will automatically scan your computer to find every installation of MT5 on it. So if you've got multiple brokers with different MT5 platforms, it will find all of them and give you the option to install the simulator on each and every one of them. In my case, you can see that it found the Exness MT5 we just installed along with some other prop firms. Make sure the checkbox next to your MT5 installation is checked before clicking install. The installation process for the simulator should only take maybe 30 seconds or less. You'll see it working through the files. Perfect. The installation is now complete. When you look at the status, it should say success next to your MT5 installation. If it says failed for any reason, you might need to run the installer as administrator or check your MT5 installation. I've got the status of this installation saying success, so we're good to go. Just click on the close button to complete the installation process. Let's run the Soft4FX Forex Simulator for the very first time. Now to do that, go to your MT5 platform or just relaunch it if you've closed it. On the left-hand side of the trading platform, you'll see a panel called Navigator. If you don't see it, just press Ctrl-N on your keyboard and it should appear. In the Navigator panel, look for a folder called Soft4FX. It should be right there in the Expert Advisors section. Click on that folder to expand it. Inside it, you'll see Forex Simulator MT5. Double-click on it to add it to your chart. A new window will pop up. This is the License Agreement and Activation window. Make sure to check the box next to Allow Algo Trading, and don't forget to also check the box next to Allow DLL Imports before clicking OK. Once that's done, you'll see a login window pop up with two options, Demo Mode and Full Mode. For this section of the tutorial, we're going to run the demo mode so you can see what the free version of the software has got to offer. Therefore, just click OK and the simulator will launch on your device for the very first time. Now, before we can start testing any trading strategy, we're first going to need to download some historical price data. The simulator uses this data to recreate past price action. Without it, there's nothing to test on. Think of it like fuel for your forward or backtesting. Without data, there's no market to trade on. And so, to get started, just click on the button that says Data Center. This will open up the simulator's Data Center window. The Data Center is where you'll get to download and manage the historical price data for the currency pairs or markets you plan to test, covering the entire testing periods you'd like to simulate. We're finally starting to get to the fun part. In this section of the video, we're going to quickly set up and run our very first simulation. Now, in order to do that, just click on the button that says New Simulation. Once that's done, the software simulation setup window will open up. This is where you'll get to configure all of the parameters for your forward or backtesting, from the pairs you'd like to trade, the time period you'd like to simulate, down to the simulation account settings you'd like to trade with. Let me quickly walk you through exactly how to set everything up step by step. After successfully selecting our preferred data provider, we will need to add the currency pair or pairs which we would like to trade to the list of tradable instruments in this particular simulation. Just select the instrument you would like to trade from the drop-down menu in step number 2 and click on the Add to List button right next to it. The instrument you selected will appear in the list of active tradable pairs for this particular simulation. If your trading edge requires analyzing or even trading multiple currency pairs simultaneously, then you're absolutely going to love this feature. But since my trading approach doesn't require trading multiple currency pairs at once, I'm just going to add the currency pair which I would like to trade in this particular simulation and move on to the next step. This right here is the Soft4FX Forex Simulator interface. Now, I know at first glance it might look a little bit overwhelming, but don't worry, we'll go through it step by step together. Think of this as your backtesting command center. It's where all the action happens. But before we start clicking around, let's take a minute to talk about the difference between the demo and full versions of the simulator, just so you know exactly what we're working with and what to expect as we go. The demo version of the simulator is completely free, and it lets you get a hands-on experience of how the simulator actually works. You can test as long as you like, and both MT4 and MT5 versions are included. It will give you a real feel for the platform's interface, trade execution, and chat replay functions. However, it does come with a few key restrictions. You can only place up to 5 trades per simulation, and you'll only have access to 2 sample years of historical data. Plus, you can't save or load your testing sessions. On the other hand, the full version completely unlocks the software. You'll get unlimited trading, access to more than 10 years of high-quality tick data, the ability to save and resume testing sessions, and free lifetime updates, all with one single purchase. It's also licensed for both MT4 and MT5, so once you pay for it, you'll get to own it forever. No subscriptions, no renewals, just pure lifetime access, unlike most of the other forex trading simulators on the market. Here's a quick question for you. How serious are you about leveling up your trading game and becoming one of those consistently profitable forex traders who are able to squeeze profits out of the forex markets like a broken ATM machine? Well, if you're ready to stop spinning your wheels, guessing your way through trades, and finally cracking the code to earning consistent profits through forex trading, then I've got something you're absolutely going to love. And guess what? It's absolutely free. I've spent months putting together a profitable forex trading crash course, which is designed to help you go from being a struggling trader to becoming a consistently profitable forex trader in a step-by-step manner. By the end of the course, you'll know exactly what you'll need to start and stop doing in order to join the ranks of the lucky few consistently profitable forex traders who are able to squeeze profits out of the spot forex market like a broken ATM machine. So what are you waiting for? Head on over to www.fxmindtricksacademy.com/blueprint to get free instant access to the crash course. It's time to start trading smarter, not harder, and finally achieve the results you've been working so hard for. Don't let this rare opportunity pass you by. Take action today and watch your trading game transform for the better. See you on the other side. The free version of the software is fantastic for learning the ropes and getting familiar with the workflow, but if you're serious about doing proper long-term backtesting and really validating your trading edge, then the full version is absolutely worth it. If you ever decide to upgrade to the full version of the simulator, you won't need to pay full price to get it if you use this 15% off discount code at checkout. That should save you a bit while you unlock all of its pro features and unlimited trading access. Now with that out of the way, let's move on to actually seeing how to manually test your trading edge using the simulator. Now that we've got the Soft4FX Forex Simulator installed and ready to go, let me quickly show you how to make your charts look pretty and clean by customizing their layouts. Right now, our price chart is still rocking the default plain and boring black and green MetaTrader look. And since we're going to be analyzing lots of price action as we go about testing the validity of our trading edge, it won't be a bad idea to have our charts looking clean and easy on the eyes. So let's sort that out first. Take a moment to customize these colors to whatever works for you. Once you're happy with how it looks, just click OK. Now with that out of the way, let us quickly add on the technical indicators which the trading strategy we're going to be using to trade throughout the simulation requires for identifying low risk high probability trade entry and exit signals. Now that we've got our chart looking exactly the way we want, let's save it as a template. That way, we'll be able to load the exact same setup on all the other time frames which our strategy uses to identify low risk, high probability trading opportunities within seconds. This little bit of prep work will save us a ton of time later on. And that's because instead of customizing each and every one of our price charts from scratch over and over again, we'll be able to load the templates we just saved to get the exact same layout, colors, and indicators automatically applied to any price chart with no extra work. Now to do that, just right click on the chart and look for an option that says Template. Click on Template, then Save Template. A dialog box will pop up asking you to name your template. Give it a descriptive name, something like the Advanced Trend Trading Strategy or whatever makes sense to you. Then type that in and click Save. Perfect. Your template is now saved and ready to go. Now, since the trading strategy we're going to be using to identify trade setups throughout the simulation uses multiple time frame analysis to find low risk, high probability trading opportunities, let us quickly launch the extra charts which we're going to be using to display the other time frames we'll be monitoring and then arrange them accordingly. If you take a close look at the screen, you'll notice that the extra charts we added still have that default black and green MetaTrader color scheme. To get them looking exactly the way we want, all we need to do is to load the template we saved a little while ago. Once we do that, the template will copy over all of our settings and technical indicators so that each chart will instantly match the clean layout from our main setup window. Now to do that, just right click on the new chart you launched and go to Template and then Load Template. You'll see your saved template in the list. Click on it. Within seconds, that chart will have the same look and technical indicators as your main setup window, lined up exactly the way you set them without you having to redo a single thing. You just went from a blank default chart to your fully customized setup in 2 clicks. This is incredibly efficient because it will help you to quickly load your template onto different charts and still have that consistent professional setup across all of them. Up here in the top left corner, we've got the daily time frame. We'll be using the daily time frame to map out the direction of the long-term trend. And right below it, in the bottom left corner, we've got the 4-hour chart. We will be using the 4-hour chart to confirm that the direction of the medium-term trend is lining up with the bigger picture. And over on the right-hand side, we've got the 1-hour chart, which is the main time frame we'll be using to spot, time, and execute trades in the direction of the trend throughout this simulation. Now, instead of jumping back and forth between time frames, you've now got all the key time frames right in front of you, ready to guide every decision you make as you go about testing your trading edge. This layout is going to make your workflow super efficient. Now that everything's in place and we're fully set up to start testing our trading edge, let's dive right into the simulation and start applying the rules of our chosen trading strategy just like we would under live market conditions, so you can see exactly how everything comes together. But before we do that, there's actually one more crucial hack I almost forgot to mention. Trust me, you're going to want to set this up right now before you go any further. If you've ever used TradingView, I'm pretty sure you know that awesome long and short position tool that they've got that lets you visualize the risk to reward ratio for any trade you're planning to take. It's actually an incredibly useful tool, but unfortunately, MetaTrader doesn't come with anything like that out of the box. But don't worry, there's a workaround I found, and it's actually really good once you set it up the right way. We're going to convert the Fibonacci retracement tool that's already built into MetaTrader to serve as our very own custom risk to reward ratio visualization tool. MetaTrader gives us full control over the fib levels of their Fibonacci retracement tool, and so with a little bit of tweaking, we can get it to show our trade entry, initial stop loss, and take profit price levels, along with the exact R multiple of the trades we take on any given price chart. Once you set this up, placing trades will get a whole lot easier because you'll know exactly where your trade entry, initial stop loss, and take profit price levels are going to be at a glance. So let me quickly show you exactly how to set this up on your price charts. Just follow along, and before you know it, in the next couple of minutes, your Fibonacci retracement tool will be fully transformed and ready to serve as a risk to reward ratio visualization tool inside MetaTrader. This tool is going to be essential for managing trades throughout this simulation, so make sure you don't skip this part of the tutorial. Alright, first things first, locate the Fibonacci retracement tool in your toolbar and then click on it to add it to any price chart. After adding it to the charts, double click on it and select it, and then right click it and select Properties. Now here's where the magic happens. You're going to see a list of levels on the left and descriptions with numbers like 0.0, 23.6, 38.2, 50.0 and so on the right. We're going to modify these levels and their descriptions to display risk to reward ratios instead of the default Fibonacci retracement levels. So go ahead and delete all of them and then add the following custom levels and descriptions. The level with the number 0 will now become your initial stop loss price level indicator. The level with the number 1 will now become your trade entry price point indicator, while the level with the number 2 will now become your 1-hour take profit price level indicator. In the same vein, the level with the number 3 will now become your 2-hour take profit price level indicator. You can also customize the labels of the levels to display descriptions like initial stop loss level, trade entry price level, 1-hour take profit price level, 2-hour take profit price level, and so on. That way, when you drag this tool onto your chart, you instantly see exactly where your take profit levels should be based on your trade setup's entry and stop loss levels. And if you would like the Fibonacci retracement tool to display the exact prices of each one of these levels, make sure to add the % and $sign in the description of the levels with no space in between them. Once you've properly configured the tool, click on the OK button to save your changes. From now on, whenever you're about to take a trade, just drag the modified Fibonacci retracement tool from your trade setup's entry price level to its stop loss price level, and it will automatically show you where your 1:1, 1:2, or 1:3 profit target price levels are going to be. No more guessing or stressing mental math. Now that we've got that sorted, let's move on to placing our very first trade following the advanced trend trading strategies rules in this sample simulation. This is where the fun really begins. As you can see on the screen, We've got a valid short trade setup signal on the GBP/JPY based on the trade entry rules of the advanced trend trading strategy. And that's because the trend on the daily, 4-hour and 1-hour time frames of the currency pair are all moving in the same direction according to the trend identification and confirmation rules of the advanced trend trading strategy, since price has successfully crossed and closed below the 360 period simple moving averages on all 3 time frames, and the confirmed fractal has fully formed on the pair's 1-hour chart. Now when I click this big green play button on the Soft4FX Forex Simulator's dashboard, price action is going to start moving forward in time. And one of the cool things about this simulator is that you can actually control how price behaves during the simulation. See this speed slider right here? You can actually use it to control how fast or slow the market moves during your simulation. At 1x speed, price action will play back at the normal real-time market speed, so it'll feel very similar to watching price charts in a live market setting. But you can also crank it up to make price move 5, 10 or even 50 times faster when you need to quickly run through a lot of data. However, for this particular demonstration, I'm not going to use the chart replay speed function. Instead, I'm going to use the next and previous bar buttons to replay price action one candlestick at a time. See these arrow buttons here? The next button lets me jump forward 1 candle at a time, and the previous button lets me go back 1 candle at a time whenever I need to. So why am I choosing to do it this way instead of just speeding through price action? Well, it all comes down to how my advanced trend trading strategy actually works. The strategy waits for a candle to completely close before we are allowed to make any trading decisions. We actually wait for confirmation at the candle's close. And that's one of the main rules of the advanced trend trading strategy. So by using the next and previous bar buttons, I can jump from one candle close to the next candle close, and that will perfectly match how I'd be trading the strategy in real life. So when a candle closes, I'll check my rules, make my decisions and act if I have to before moving on to the next candle close. This approach forces me to slow down and follow my trading strategy's rules exactly the way they were meant to be applied. On the flip side, if I just press play and speed through the markets, candles would form and close too quickly, and that could cause me to miss key candle closes or even tempt me to react to price action in the middle of a candlestick's formation, which would completely violate my trading strategy's rules. Plus, going candle by candle would force me to stay disciplined and carefully think through each decision, which is exactly the type of practice we want when backtesting. Now with that said, let me quickly place a sell stop pending order to get into the market with a short trading position, since this setup has fully met all of our entry criteria and we are now just waiting for price to break below the lowest price of the signal candlestick. As you can see on the screen, the simulation trading account we're working with has a starting balance of $100,000. And since our trading strategy recommends risking only 1% of our account's starting balance per trade setup, we'll be risking no more than $1,000 on each trade we take. But according to the Advanced Trend Trading Strategy's trade and risk management rules, we're supposed to split our risk between 2 entries. 80% of our risk per trade setup will be allocated to the trading position, which we will be placing with a fixed 2-hour profit target, while the remaining 20% will be allocated to the trading position, which we will be placing without a predefined profit target. So for this particular example, $800 will go to the pending order, which we will be placing with a profit target, while $200 will go to the pending order, which we will be placing without a predefined profit target throughout this particular trading simulation. This will give us a balanced approach for managing the risk on each trade we take. It will also help us to lock in some profit while still leaving part of our trading positions open in case the market decides to keep pushing further in our direction. But before we'll be able to place those pending orders, we're first going to need to identify the exact trade entry, initial stop loss, and to our profit target price levels for this short trade setup according to the Advanced Trend Trading Strategy's rules. And to do that, we'll be using the modified Fibonacci retracement tool which we built a little while ago. The one that helps us to instantly visualize our trade setup's risk to reward levels. Now when I drag the Fibonacci retracement tool, which I modified to serve as my risk to reward ratio visualization tool, from this short trade setup's entry price point to its initial stop loss price level, you'll notice that the trade entry for this setup's sell stop pending orders should be placed at 150.696, while their initial stop loss should be placed at the 153.190 price level according to the Advanced Trend Trading Strategy's rules. Now that we have the exact values for all of the price levels we need, we could go ahead and place the sell stop pending orders for this short trade setup. But according to the Advanced Trend Trading Strategies rules, if we place pending orders and price doesn't trigger them when a candle closes, we must delete those pending orders and replace them with fresh ones based on the new price levels. And that's because both the entry and initial stop loss price levels for this strategy's trade setups are dynamic, which simply means that they can change as new candles form. For example, according to the Advanced Trend Trading Strategy, the initial stop loss price level for short trade setups should be based on the location of the 60-period simple moving average which was applied to prices high on the trade setup time frame, while the initial stop loss price level for long trade setups should be based on the location of the 60-period simple moving average which was applied to prices low on the trade setup time frame. And since moving averages update every time a candle is created, the exact price of the simple moving average is also going to shift with the formation of each new candle. So if we were to place pending orders and a new candle closes without triggering them, the 60-period simple moving average applied to prices high or low might move up or down, which would mean that their initial stop loss price level would also change. Now at that point, those original pending orders will no longer be valid according to the strategy's rules. And so we must delete them and place new ones using the updated stop loss price levels. In the same vein, identifying a valid trade entry price level according to the Advanced Trend Trading Strategies rules should always be based on the most recent confirmed fractal on the trade setup time frame. So if price were to continue to move without triggering the pending orders we placed, a new confirmed fractal might form. And when that happens, that new confirmed fractal will be the one which will signal the new trade entry price level, and the previous confirmed fractal will then become outdated. This would automatically make the previous pending orders which we placed become invalid because they were based on the old confirmed fractal which just became outdated. So again, we must delete those old pending orders and place fresh ones using the latest confirmed fractal. Now, you might be thinking, this doesn't sound too bad. I'll just update my pending orders after each candle close. And you'd be right. In a live trading environment, deleting and placing fresh pending orders with the updated price levels would only take a minute or two after each candle closes on the trade setup time frame. It's just part of the routine. But during a simulation, where moving forward one candle is just a click of a button, constantly deleting and replacing pending orders with every single candle close can start to feel tedious and time-consuming, especially when you're clicking through dozens of candles that never actually trigger the trade setup. And that's why placing pending orders as soon as a trade setup appears during a simulation can feel quite frustrating because you might end up updating those orders over and over again as the market produces new fractals and the simple moving averages keep shifting with each new candle close. And that's why instead of placing pending orders right away and constantly updating them, I prefer to first let price move forward and confirm whether it would have actually triggered a trade setup's pending orders during a simulation. If it did, great. I just step back one candle, place the pending orders exactly where they should have been, and then move forward again to watch the trade unfold. This method keeps the whole process clean and fully aligned with the strategy's rules without wasting time adjusting pending orders that would have never been triggered in the first place. The setup you're seeing on the screen now shows exactly why this method is so helpful. And that's simply because even though all of our trading strategies entry rules were met, price never actually broke below the low of the fractal candle. So the trade setup's pending orders would have never been triggered. Meanwhile, the 60-period simple moving averages kept shifting as new candles closed, meaning our stop loss would have kept changing over and over again, and we would have had to keep placing and deleting pending orders with each candle close that led to the change of the trade setup's initial stop loss price level or its trade entry price level when new confirmed fractals got formed. If you take a close look at the screen, you'll notice that after the most recent confirmed down fractal got formed on this chart, price eventually went on to break below the low of the candle which had the fractal printed below it. This simply means that if we had placed sell-stop pending orders for this short trade setup, following the Advanced Trend Trading Strategies trade entry rules, they would have been triggered. And so what I'm going to do now is step back one candle using the previous bar button and then place sell-stop pending orders exactly where they should have been according to the Advanced Trend Trading Strategies entry rules. Once that's done, I'll move forward one candlestick at a time to see how the trade would have played out. But before we do that, let's quickly document this trade setup properly. Since this is the first trade we are taking in this simulation, I'll just name the folder for the trade setup screenshots Trade 001 inside my Trading Simulation Journal Screenshots folder. First, I'll save a screenshot of the daily timeframes chart with the title Step 1, Higher Timeframe Trend Identification. Next up, I'll save a screenshot of the 4-hour timeframes chart using the title Step 2, Higher Timeframe Trend Confirmation. And then finally, I'll save a screenshot of the 1-hour timeframes chart with the title Step 3, Low Risk, High Probability Setup Identification. Once that's done, I'll go ahead and place 2 sell stop pending orders for this short trade setup, risking 80% of my max risk per trade on one of them and the remaining 20% on the other one, following the Advanced Trend Trading Strategies trade entry and risk management rules. I'll then save a before screenshot showing the moment the trade got triggered, and then after screenshot once I close the trade according to the Advanced Trend Trading Strategies trade exit rules. As I go on to place the sell stop pending orders for this short trade setup, let me quickly walk you through a couple of setup choices I'm making in the Soft4FX Forex Simulator. Understanding the why behind these decisions will help you to avoid making some pretty common rookie mistakes as you go about doing your own testing. If you take a close look at the screen, you'll notice that I'm using the option to risk a certain amount of money to set my risk per trade instead of the option to risk a certain percentage of my simulation account's balance or lot size. And here's why that matters. You see, when you use the risk in money option to set your risk per trade, all you'd need to do is simply type in exactly how much money you'd like to risk on each trade you take. The simulator will then automatically calculate the correct lot size to place the trade with based on the exact location of your trade entry and initial stop loss price levels. This will keep our risk management consistent with the Advanced Trend Trading Strategies rules, since we'll be risking exactly what we intend to risk, nothing more, nothing less. Now I know you might be wondering, why not just use the option to risk a certain percentage of the simulation account's balance? Well, the problem with using that method to determine our risk per trade is that it will calculate your risk based on your simulation trading account's balance. And so, as your account balance grows or shrinks during testing, your risk per trade amount is going to keep changing along with it. To keep things simple, the Advanced Trend Trading Strategy calls for risking 1% of your starting account's balance and not your account's current balance. So we need that $1,000 risk to stay fixed throughout this entire simulation. Now, in case you are wondering, why not just use the lots option to set our risk per trade then? Well, that would mean using the same lot size for each and every trade, which completely ignores the fact that stop loss distances vary from trade setup to trade setup. Some setups might have a 50 pip stop loss, while others might have a 150 pip stop loss. If you're using a fixed lot size for both, your actual risk amount would be all over the place, and that would throw your entire risk management out the window. So by using the option to risk a certain amount of money to set our risk per trade, we eliminate all of that guesswork and human error. This ensures that every trade is executed with the exact risk allocation which the Advanced Trend Trading Strategy calls for, no matter how large or small the stop loss distance is. It doesn't matter if the stop loss for the trade setup is 50 pips away or 150 pips away. Our risk per trade setup stays exactly where we want it to. Another thing you'll notice is that I'm using the simulator's visual mode option to set the exact trade entry, initial stop loss, and profit target price levels for the short trade setup's sell stop pending orders. And that's just because it's way more efficient. Visual mode lets me click and drag the lines which represent a trade's entry, initial stop loss, and profit target price levels directly on the price charts to set them. That's faster and much more intuitive than manually typing in price levels. Plus, it makes it incredibly easy to double check that everything lines up correctly with the modified Fibonacci retracement tool we're using to mark trade entry and exit price levels. When you're running through multiple setups during a simulation, this visual confirmation makes it much easier for you to spot mistakes before they slip through the cracks. Especially small things like being a few pips off, which can actually distort the accuracy of your testing results over time. Remember, the goal here isn't speed. It's accuracy and consistency. And since accuracy and consistency matter far more than speed during testing, visual mode just makes the whole process cleaner and much more reliable. Once you get used to the process, it becomes second nature. And more importantly, it keeps your testing results clean and trustworthy. As you can see on the screen, this particular short trading position ended up closing with a relatively small amount of profit. And that's because price crossed and closed back above the 360 period simple moving averages on the pair's 1 hour chart before hitting the setup's initial stop loss or 2-hour profit target price levels. And even though it wasn't a big win, it was still a clean, properly managed trade from start to finish. So it was actually a good trade since we followed our trading strategies rules. And now that it's closed, we're allowed to move on to finding our next valid trade setup following the advanced trend trading strategies rules. If you take a close look at the charts again, you'll notice that the direction of the trend on both the daily and 4-hour charts of the GBP-JPY currency pair are still clearly bearish since price is still trading below the 60 period simple moving averages on both time frames. Now at this point, we're just waiting for price to also cross and close below all 360 period simple moving averages on the 1 hour chart, followed by the formation of a confirmed down fractal. Once that happens, we'll be looking to take another short trading position when price breaks below the low of the candle which had the down fractal printed below it, just like the strategy's trade entry rules require. And since all of those conditions have now been met, I'll simply go ahead and place 2 sell stop pending orders following the advanced trend trading strategies trade entry and risk management rules. I'll also take a moment to save this trade setup screenshots for my trading simulation journal. And since this is the second trade we're taking in this simulation, I'll just name this folder Trade 002. Again, I'll save a screenshot of its daily time frames price chart with the name Step 1. Higher time frame trend identification. Once that's done, I'll then go ahead and save a screenshot of its 4-hour time frames price chart with the title Step 2, Higher time frame trend confirmation. And last but not least, I'll save a screenshot of its 1-hour time frames price chart with the title Step 3, Low risk high probability setup identification. After placing the sell stop pending orders for this short trade setup, I'll save a before screenshot showing the moment price action went on to trigger the trade, and an after screenshot when I closed the trade following the trading strategy's exit rules. As you just saw on the screen, price went on to hit the 2-hour profit target for this short trade setup. So according to the Advanced Trend Trading Strategies trade management rules, I'm going to move the stop loss for the trading position which was allocated 20% of our max risk per trade from its initial stop loss price level down to break even by clicking on this button. Now at this point, this trading position will only be closed if one of 2 things happen. Either price crosses and closes above the 360 period simple moving averages on the pair's 1 hour chart, or price pulls back to the trade's entry level and stops us out at break even. In the meantime, let me quickly save a screenshot of this trade's exit for our sample simulation trading journal. As you can see, price eventually came back up and stopped us out at break even. After taking only 2 trades, this simulation trading account is up by about 1.5%, all while strictly following the rules of the advanced trend trading strategy, managing risk properly, and documenting every step of the process. One of the things I really like about the Soft4FX Forex Simulator is the fact that it lets you export all of the data from your closed trading positions as an Excel spreadsheet. This is perfect for nerdy traders like myself who like to dig deeper into a strategy's performance data to extract insights that go way beyond the stats the simulator's standard reports provide. Now, while exporting your closed trades data is great for crunching the numbers and also squeezing out as much information as you can from your trading strategy's performance metrics, there's another crucial part of the testing process that I would like you to really focus on, and that's properly documenting every trade you take with screenshots. This is important because screenshots give you visual proof of the reason why you took a trade and not just how it performed. They also allow you to go back and verify that you actually followed your trading strategy's rules, confirm that the setup was truly valid, and see exactly what the market looked like when you pulled the trigger. Over time, this makes it so much easier to spot patterns in your behavior, catch recurring mistakes, and even identify which trade setups consistently perform the best. And this is something that raw numbers alone probably won't be able to show you. Without this visual documentation, you will find it extremely difficult to know whether the winning trades you took were the results of good execution or luck, and you will also find it difficult to know which losing trades were valid setups that just didn't work out and which ones you shouldn't have taken at all to begin with. Think of it this way. Your trading stats tell you what happened, but screenshots show you exactly why it happened. They visually capture your entire decision-making process from setup identification down to trade execution. Having this visual record makes it easy to review your trading performance, identify mistakes in your trade execution, and it also gives me the ability to confirm that you genuinely understand the advanced trend trading strategy and whether or not you're applying its rules correctly. And so, during the testing phase, I need you to properly document each and every trade you take so that I can properly evaluate your understanding of the strategy and also verify that you're executing trades correctly. As you can see on the screen, I titled the Trello board which we'll be using to journal our trades, the Trading Edge Testing Board. And to make things as simple as possible for you, I've set the board up as a template so you won't need to build yours from scratch. All you'd need to do is click on the button which says Create Board from Template, and Trello will instantly generate your own personal copy of the Trading Edge Testing Board. Once your board is created, you'll notice that it's divided into different lists based on the testing phase you're currently at. This makes it very easy for both you and your trading coach or accountability partner to instantly see where each trade belongs and exactly how you're progressing through the program. And since backtesting is the first layer of the testing phase, the backtesting trades list is where you'll log the trades you take using in-sample historical data to find out if your trading edge is profitable and exactly how it would have performed in the past. However, just because a trading edge worked in the past doesn't mean it will work in the future. And that's why forward testing is the second layer of our trading edge testing process. The forward testing trades list is meant to record all the trades you take using out-of-sample historical data to confirm that your trading edge can actually handle market conditions other than the one which it was exposed to during the backtesting phase and still deliver results. And last but not least, the live testing trades list is where you're supposed to document the trades you execute on a small live trading account with real money to prove that your trading edge can maintain its effectiveness and still deliver results despite the uncertainties of live market conditions. Live testing is actually the third and final phase of our three-phased trading edge validation process. Assuming you've just completed the first trade in the backtesting phase, what you're going to do is come on over to the backtesting trades list, create a new card, and name it Trade 001. Your second trade will be Trade 002, while your third trade will be called Trade 003, and so on. This numbering system is important because it keeps everything clean, organized, and easy to review later on, especially once you've taken dozens of trades. Once the card is created, click on it to open it and then upload all of the screenshots for that particular trade inside it. Each card should contain all the screenshots we talked about earlier on in the video. So if you're trading with the advanced trend trading strategy, for each trade, I'd expect to see a screenshot of the daily time frame showing the trend's direction on the higher time frame, a screenshot of the 4-hour time frame showing an alignment between the direction of the long-term trend on the daily time frame and the medium-term trend on the 4-hour chart, a screenshot of the 1-hour time frame showing the low-risk, high-probability trade setup, and the before and after screenshots showing how and when the trade was triggered and also when it was closed according to the trading strategy's rules. You can simply drag and drop those screenshots directly into the card or upload them using the attachment upload button. Everything related to a trade setup should stay inside a single card. This way, you can focus on what really matters, which is executing the strategy correctly and properly documenting your trades without worrying about how to organize everything. I also use labels to tag the trades I take. For example, good wins are trades that met all of my chosen trading strategy's entry and exit criteria, which were also executed correctly according to the strategy's rules and then closed with a profit. These are the ideal trades. You did everything right and the market rewarded you for it. On the other hand, good losses are trades that also met all of my chosen trading strategy's entry and exit criteria and they were executed properly, but they ended up closing at a loss. These trades are actually just as valuable as the good wins because they prove that you're following the trading strategy's rules, but sometimes the market just doesn't move in your favor and that's completely fine. Bad wins are trades that were closed profitably, but they didn't actually meet all of my chosen trading strategy's entry and exit requirements, and so they were executed incorrectly. These might feel good in the moment because you made money, but they are actually dangerous because they can reinforce bad habits and make you think that rule breaking is acceptable when it's absolutely not. Because more often than not, this habit ends up leading to catastrophic losses. On the flip side, bad losses are trades that both violated your chosen trading strategy's rules and also lost you money. These are the worst case scenario trades because you broke the rules and got punished for it. And last but not least, break-even trades are trades that were closed at or very near the entry price, meaning you didn't make or lose any significant amount of money on them. These can either be good or bad depending on whether or not you followed your trading strategy's rules. The reason why I'm being so insistent about this process is simple. This isn't just a course you're supposed to watch passively and hope things click. This program is designed to help you transform into a consistently profitable trader by building the right habits, execution skills, and decision-making processes in a step-by-step manner. By reviewing your trade screenshots inside this board, I can clearly see whether your entries and exit match the trading strategy's rules, whether your stop loss and profit targets were placed correctly, and whether your trade management decisions were executed properly. This will tremendously help me to evaluate your understanding of the advanced trend trading strategy before we move on to the next logical step in the program. So if this feels detailed or a bit involved right now, just bear with the process and work with me. Every single step of the process was intentionally designed to put you in the best possible position to succeed in the long term. Alright, now that this trade has been properly documented and added to our Trading Edge testing board, we're free to move on to documenting the next valid trade setup, and that's exactly what we're going to do next. If you'd like to share your Trading Edge testing Trello board with your trading coach or accountability partner, you'll first need to change the board's visibility from private to public. Once you've done that, simply share the board's link with them so that they can access it. Now, in the first half of this video, I showed you how to download MetaTrader, install and configure the Soft4FX Forex Simulator, and use the free MT5 version to start backtesting your trading strategy. However, because we were using the free version of the simulator, we were only able to take a handful of trades with it before reaching its limitations. And so, as promised, we're now going to switch over to the fully unlocked MT4 version of the Soft4FX Forex Simulator, where those restrictions no longer apply. This time, we'll be able to continue taking trade after trade, just as you would during a real backtesting session, while also exploring some of the additional features the paid version has to offer. To walk us through the rest of today's lesson, I'd like to hand things over to Richard, who is one of our trading instructors here at FX Mindtricks Academy. Richard, over to you.
Thanks, Anas. All right, let's get to work. As promised, let's continue our backtesting session using the fully unlocked MetaTrader 4 version of the Soft4FX Forex Simulator. Unlike the free version we used earlier, the paid version allows us to take as many trades as we need, making it much easier to build a statistically significant sample size and properly evaluate a trading strategy's long-term performance. So, let's jump back into the charts and continue taking trades.
A few moments later.
All right, now that we've finished backtesting the GBP/JPY currency pair over our sample testing period, let's pause for a moment and take a closer look at our sample trading edges backtest results. And that's because running a backtest is only half the battle. What truly matters is knowing exactly how to read what the numbers from the trading strategy's backtest performance metrics are actually telling us. And more importantly, how to interpret those numbers correctly so that we can objectively decide whether or not our chosen trading edge deserves any further validation. As you can see on the screen, this is the performance summary generated by the Soft4FX Forex Simulator. I ran this backtest on a simulation account which was funded with 100,000 British pounds. And after executing all of the trade setups generated by the advanced trend trading strategy throughout the sample backtesting period, which ran from August 2018 to October 2021, the account ended up with a net profit of £41,302. That's a 41.3% ROI over the 3-year period. But I don't want you to get fixated on the exact monetary amount here, because what we're more interested in at this stage of the trading edge validation process is knowing whether our equity curve is moving in the right direction and whether or not that growth is actually happening in a controlled and consistent manner. This smooth, upward-sloping equity curve shows us that the advanced trend trading strategy's positive results weren't just driven by a few lucky trades or outlier wins. On the contrary, its performance was relatively consistent throughout the sample testing period. Now at this point, a lot of traders would stop right here and say things like, "The strategy looks good, let's trade it live." But experienced traders know better. They know that before getting all excited about the returns of any trading strategy, they'd first need to ask a much more important question, and that is, what did it actually cost to achieve those results? And that leads us directly into the next performance metric we need to talk about, and that is drawdown. Put simply, drawdown is the thing that separates trading strategies you can actually stick to trading with from the ones that look good on paper, but destroy you emotionally in live trading. The 3 main types of drawdowns you'll likely come across in strategy performance reports are absolute drawdown, maximum drawdown, and relative drawdown. Absolute drawdown is pretty straightforward to understand, and that's because all it does is measure the furthest your account dipped below its initial starting balance. For example, if the starting balance of the account you were trading with was $100,000 and the account never dropped below that initial amount, your absolute drawdown would be 0. As you can see on the screen, the absolute drawdown for the advanced trend trading strategy was only minus 1.38%. This simply means that throughout the entire 3-year sample backtesting period, our simulation account barely dipped below its initial starting balance. On the other hand, maximum drawdown tracks the largest drop from an equity peak down to the subsequent lowest point before the account climbed back up again. In other words, it shows you the worst losing streak you'd have had to sit through before things turned around. For example, if your account grows from £100,000 up to £150,000 and hits a rough patch and drops down to £120,000 before recovering, that £30,000 drop from the peak of £150,000 down to £120,000 would be your maximum drawdown. From a risk and trading psychology standpoint, this is the number that really matters. Why? Well, that's because it represents the kind of pain you'd actually have to sit through in real life. It tells you exactly what you might have to endure emotionally and also helps you to understand the real risk you're taking on. A trading strategy that makes a ton of money but comes with massive drawdowns along the way is usually very hard to trade with or execute consistently when real money is on the line. Ideally, you want to find a trading edge with drawdown levels that stay within your predefined risk rules and also feel realistic enough to tolerate over a long period of time. If the drawdown makes you uncomfortable on paper, it's probably going to feel 10 times worse when real money is involved. As you can see on the screen, the maximum drawdown for the advanced trend trading strategy throughout the entire 3-year sample backtesting period was about £8,403 or 5.85% of our account's balance. If you take a look at the number of closed trades from this backtesting session, you'll notice that Soft4FX Simulator's performance report is showing us a total of 296 trades. But in reality, the actual number of the trade setups we executed was 148. The reason you're seeing 296 trades in the simulator's performance report is because it is counting each individual entry from our trading strategy's 2-trade entry system as a separate trade. In the grand scheme of things, the number of trades taken during a simulation matters a lot because the performance of a trading strategy cannot be judged on just a handful of trades here and there. We need a statistically significant sample size for the results to tell us anything useful. The more trades we have, the more reliable our statistics become, and the less likely our results are being skewed by randomness or luck. And this is exactly why we always test specific currency pairs over clearly defined time periods instead of jumping from one pair to another or just testing for a few weeks. Taking 148 trade setups using a swing trading strategy over a 3-year period gives us a solid, reliable foundation to properly evaluate the performance of our chosen trading strategy. It's worth noting that the number of trades required to validate a strategy can vary depending on your trading style. Traders who use scalping or day trading strategies will typically need to take a significantly higher number of trades to properly confirm the validity of their trading edge across a wide range of market conditions, including trending, ranging, and consolidating environments. And since scalping and day trading strategies generate trades much more frequently than swing or position trading strategies, a larger sample size helps ensure that the results reflect the true performance of the strategy rather than short-term market behavior or randomness. It's important to note that traders using scalping or day trading strategies will need to take significantly more trades to prove the validity of their trading edge across a wide range of market conditions, such as trending, ranging, and consolidating markets. Since scalpers and day traders have a much higher trade frequency compared to swing traders and position traders, they require a larger sample size to achieve the same level of statistical significance. While 148 setups over 3 years works well for swing trading validation, a scalper might need hundreds or even thousands of trades over the same period to truly assess their strategy's robustness. Quick question. Which one of these do you think is more important in trading? A high win rate or a high positive reward to risk ratio? While most inexperienced traders will get stuck arguing for one over the other, professional traders know that neither of them matters on their own. And that's because you can have a strategy that wins only 30% of the time and still be very profitable as long as your winning trades are significantly larger than your losing trades. And on the flip side, you can have a strategy that wins 70% or even 80% of the time and still lose money if your average loss is bigger than your average win. According to the Soft4FX Forex Simulator's performance report, out of the 296 closed trades we took during this backtesting session, 130 of them were winning trades while the remaining 166 were losing trades. When you do the math, that gives us a win rate of about 43.9%. Now I know you're probably thinking, wait a minute. We lost more trades than we won? And yes, that's correct. But like I told you moments ago, the important thing you need to understand about trading is a higher win rate does not automatically mean a better trading strategy. What really matters is expectancy. In other words, how much does the strategy you're trading with makes on average per trade once both wins and losses are taken into account? And that's because you can have a trading strategy with a low win rate and still be very profitable as long as your winning trades are significantly larger than your losing trades on average. And on the flip side, you can also have a trading strategy with a high win rate and still lose money if your losses are bigger than your wins on average. So it's not about winning more trades than you lose, it's about making more money from your winners than you give back to the market through your losers. And this is exactly why having a positive risk-to-reward ratio structure plays such a huge role in the risk management plan of the advanced trend trading strategy. It was actually intentionally designed to do exactly what profitable trend trading requires, and that is to help you cut your losses short and let your winners run when a strong trend is moving in your favor. Expectancy tells us how much a trading strategy is expected to make or lose per trade, on average, over a large sample size. It combines your win rate and your reward-to-risk ratio into one simple number. If a trading strategy's expectancy is positive, that simply means that the strategy has a statistical edge in the markets. If it is negative, however, that just means that the strategy has no statistical edge in the markets and it is more likely to produce losses over the long run. And that's why expectancy is such an important metric. It cuts through the noise and helps us to separate profitable strategies from unprofitable ones. It doesn't care whether you're a high win rate trader or a low win rate trader. It only cares whether your numbers actually work together to produce profits over time. And this is exactly why, during backtesting, we're not just looking for trades that feel good or look clean on the chart. We're looking for a positive expectancy because that's the thing that will tell us whether or not a trading strategy is mathematically capable of making money when executed consistently. In simple terms, positive expectancy is the thing that turns random trades into a real, solid trading edge. But before we continue to dissect the results from our strategy's backtest, let's quickly talk about something that trips up a lot of traders when they first start interpreting backtesting data. You see, when you test a trading strategy and find that it has a 40% win rate, it's quite tempting to think that exactly 4 out of every 10 trades you take with it will turn out to be winners. But that's not how probability works in trading or in anything else for that matter. Let's use a coin flip as an example, because that'll make it very easy to visualize this in action. Even though a coin has a 50% chance of landing on either heads or tails every single time you flip it, you're not guaranteed to get exactly 5 heads and 5 tails when you flip it 10 times. You might get 6 heads and 4 tails. At other times, you might get 8 heads and 2 tails. Heck, you might even flip the same side 10 times in a row. That 50% distribution is only going to start revealing itself over hundreds or maybe even thousands of flips, as opposed to only a handful of flips. Forex trading works in the exact same way. In a sample size of 1,000 trades, there's actually over a 90% chance of hitting 10 consecutive losing trades at some point, even with a strategy that wins 45% of the time. You can see this play out clearly in the backtest results of the advanced trend trading strategy. The strategy's overall win rate across the hundreds of trade setups which were taken sits at just over 40%. But when you zoom in on individual months, the numbers tell a very different story. And that's because only a handful of trades were taken with it on a monthly basis, since the advanced trend trading strategy is a swing trading strategy. There were months where every single trading signal it generated ended up hitting its stop loss. And there were months where every single trade it signaled ended up hitting its profit target. That's just the natural variance of probability playing out in real time. And that's why we don't draw conclusions about a strategy's performance from a handful of trades. A rough patch doesn't mean the strategy is broken, and a hot streak doesn't mean you've cracked the financial markets. You need a large enough sample size of trades before the results would start to reflect the strategy's true performance. And that's precisely what backtesting helps you build. And just to be clear, the win rate we're talking about in this example is what I observed over this particular set of trades. It is not a guarantee of what you'll see over your next 100 trades in the live market. The next set of trades might produce more winners just as easily as it could produce fewer wins, and both outcomes are perfectly normal. But over time, across a large number of trades, your results should start to trend toward that figure. But no two samples will ever be identical, and expecting them to be will only work against you. The sooner you internalize this, the better equipped you'll be to stay the course when things inevitably get uncomfortable. This is what it truly means to think in probabilities as a trader, and it's one of the most important mindset shifts you'll need to make if you want to survive and thrive in this business long term. Another pretty important metric we're going to talk about is the profit factor. The advanced trend trading strategy's profit factor at the end of this backtesting session was 1.71. This simply tells us how much the strategy made compared to how much it lost. In other words, for every dollar we risk, we're making $1.71 back. A profit factor above 1 means the strategy is profitable. The higher it is, the more efficient the trading edge tends to be. In the trading world, anything above 1.5 is generally considered pretty solid. But again, this number only matters when viewed alongside drawdown, consistency, and sample size. No single metric should ever be judged in isolation. You need to look at the complete picture, how all these numbers work together, to truly understand whether a trading strategy has a real edge in the markets or not. When you take a step back and look at everything we've just gone through, you'll notice that the primary goal of this backtesting session was to answer one simple yet important question, which is, does this trading strategy show evidence of having an edge under these specific market conditions? And based on what we're seeing here, that is, the 41% return on investment, the maximum drawdown of just 5.85%, and the profit factor of 1.71 across 148 trade setups? The answer to that question is yes. And that simply means that the strategy has passed our first layer of validation. However, it's important to understand what backtesting can and can't tell us. You see, backtesting doesn't guarantee future performance. All it really does is give us enough evidence to decide whether or not a trading strategy is worth taking through the next stages of validation.